Hey guys, it's a new month, so you know the drill. I'll share our Tfsa dividend income for the month of January. Let's do this! Before I jump into who paid us and how much, let's glance at our portfolio's dividend calendar. January, April, July, and October are the bigger months, and February, May, August, and November are the smaller months. The other months land somewhere in the middle. In January, we received dividends from the following 11 stocks. Like usual, we'll go through each paycheck we received, adding up our totals along the way, starting with the smallest payer, not paycheck. I want to thank all of you that subscribed lately. After 20 videos, we finally passed the 1,000 sub mark and are truly thankful that awesome people like you actually want to watch our videos. We're also excited that we have almost 700 followers on Blossom Social. If you haven't downloaded it yet, it's available for Android and iOS. You can just click the link below. You'll be able to follow me and some of the even more awesome YouTubers out there that I don't even have to name. I hope to catch you guys there. Now for the dividends. Our smallest dividend received was 73 cents from Vanguard's S&P 500 Index ETF, VFV. It provides close to 0% of our total dividend income. This will never provide a huge portion of passive income for us, as it is the growth play for us in our Tfsa. We're using it to diversify into the big US stocks we will not own individually. I think the S&P 500 still has room to drop despite the crazy rally. Its PE average of 22 is still above historical averages, especially during a bear market. I plan on really adding to this position if the price is right. The next paycheck was $106.01 from Algonquin Power and Utilities. It provides us with 3.8% of our forward yearly dividend income, down substantially. It is trading well above their 5-year average yield of 5%, which could indicate absolutely nothing, considering how much the stock was decimated in November. The last dividend raise was 6%, and it has a 10% 5-year CAGR on its dividend, but they had a 40% dividend cut announced, which will throw all those numbers off next month. This bad boy just lost its 12-year dividend growth streak. Chihuahua. So after 2 paychecks, we clear $100 at $106.74. Next up is our second smallest dividend payment of $23 from our one closed-end investment fund, Canoe EIT Income Fund. It provides us with 4% of our yearly dividend income. EIT has consistently paid out 10 cents a month. The more the years go by, the harder it is to get rid of this income fund because of how well it has performed. I have no intention of increasing this position for more income. I still only focus on dividend growth stocks on my Tfsa. This finished the year up 10%, including its distribution. Bravo, EIT. This brings us to $129.74. Our next pay was $68.67 from Telus Corp. They provide us with 4.3% of our yearly dividend income. Telus has been trading down and now yields 4.9%, 12% higher than its average yield of 4.4%. The most recent dividend raise was a modest 3.7%, bringing its growth streak to 19 years. It will be reporting its earnings in early February. Telus has a 5-year CAGR on its dividend of 6.6% and a 5-year CAGR on its stock price of 4.4%, making for a good total return. Telus is more about total return than just the dividend. After 4 paychecks, we are just shy of $200 at $198.41. Our next paycheck was from the brother of Telus, BCE Inc. at $93.84, way down from Q4 of $155.48. This now represents 5.8% of our forward annual dividend income. It used to be overweight at 8.8%. BCE has been growing dividends for 14 straight years at a 5-year CAGR of 5.1%, with its most recent dividend increase of 5.1% as well. BCE has underperformed compared to Telus with just a 1.8% stock price CAGR over 5 years. Its current yield of 5.9% is above its 5-year average yield of 5.3%, which may indicate it is slightly undervalued right now. Its PE is above its 5-year average, which is a mixed signal showing it may be overvalued. What a crazy market we're in. So at about the halfway point, we're at $292.25. Our best performing stock, Capital Power Corp, paid us $120.64. This represents 7.3% of our annual dividend income. CPX finally started to retrace with the rest of the market, down 3.5% to start the year. It has a yield of 5.2%, which is 11% below its 5-year average yield of 5.8%. This could indicate it is overvalued right now. The most recent dividend increase was 5.9%. That increase was a little lower than their 6.9% CAGR over the past 5 years. They have an annual dividend growth guidance of 6% through to 2025. After the drop in price, I'll continue buying back the shares I didn't want to sell last September. After this big dividend paycheck, and just past the halfway point, we're at $412.89. Next, we were paid $45.32 in distributions from SmartCentres Real Estate Investment Trust. They now provide us with 8% of our forward annual dividend income as one of 2 stocks in the real estate industry as a retail REIT. They're trading above their 5-year average yield of 6.1% at a yield of 6.6%. SmartCentres finished the year down 11%, including its distributions. Year to date, it is up 5.3%. It is trading around my yield on cost, so I'll continue to add to this position slowly. They have a 5-year dividend growth rate of 1.6%, almost matching inflation, but have not increased dividends since 2019, a few months before the pandemic started. It'll be interesting to see if all their new developments lead to a larger distribution. With this distribution, we hit $458.21. Next, we were paid $136.06 by Tfsa Energy Corp. This represents 8.1% of our annual dividend income. I love that they have grown their dividends for 22 years at a rate of 7.6% over the past 5 years. Their expected future dividend growth guidance is 3 to 5%. Its most recent dividend increase was just 3.4%. It is currently yielding 6.3%. This is 17% above its 5-year average yield of 5.4%, which may indicate it is undervalued. There has been a lot of bad news around them lately. It is surprising TRP's stock price is up 6.2% to start the year. I'll continue to buy more shares to replace the ones I sold last year. After another big dividend paycheck, we approached $600 at $594.24. For our 9th paycheck, we have our monthly financial payer, First National Financial. We receive $50.40. FN provides us with 8.8% of our annual dividend income. First National finished the year negative 6.6%, including its dividend. To start this year, it is up 7.8% compared to the TSX at 6.8%. Currently, it provides a 6.1% yield. With a 5-year average yield of 5.8%, this is trading near its average. By PE ratio, it's on the expensive side still. I am comfortable adding to this position despite the general sentiment about the real estate market in Canada and the rising cost of borrowing with the possible delinquencies. First National Financial had a small 2.1% dividend increase last year. That makes it 11 years of dividend increases and a 5-year dividend growth rate of 5.3% to go along with a 6.6% 5-year CAGR on its stock price. Not too shabby. With that monthly dividend, we get to $644.67. Our next dividend was $164.80 by Bank of Nova Scotia. This represents a massive 9.6% of our forward annual dividend income. BNS has been paying consistent dividends since 1833. The most recent dividend raise was 3%. It is currently yielding 5.7%. It has a 5-year CAGR of 5.9% for its dividend and has a 5-year average yield of 5.5%. This has been running up each month as the yield used to be substantially higher. Its PE is under its 5-year average of 11.1 at 8.8, an indicator it is undervalued. The banking sector tanked with the market, but BNS especially so. Year to date, it is up most of all the banks, up 9%. It still has a miserable negative 2.5% 5-year CAGR on its stock price. With a payout ratio of 50%, I don't see the dividend increasing anytime soon. That supersized dividend got us past $700 and $800 to $809.47. And lastly, our largest holding, RioCan Real Estate Investment Trust. They paid us a distribution of $62.46. This company provides us with a massive 10.7% of our forward yearly dividend income. It has a 5-year average dividend yield of 6.1%, which is drastically higher than the current yield of 4.6%. This is mainly due to RioCan slashing that dividend by 33% back in 2021. The most recent dividend increase was 6.3% last year, or half a cent a month. I drip 2 to 3 shares every month as this is a core holding for us. However, I will trim shares when I see the run up too much and become even more overweight than it already is. January finished the month up 9.4%. I don't see this rally lasting with such strong headwinds. I am still expecting a modest dividend raise this year to go in conjunction with the forecasted target 10 to 12% return. So after all 11 paychecks, big and small, our grand total is $871.93. Our top 3 dividend payments accounted for $421.50, or 48% of the $871.93 of dividend income for the month of January. This was almost $300 less than the previous year because of selling 30% of our portfolio in September of 2022. As we grow the portfolio, the top 3 should account for less of a percentage of our January income. I never want to be too dependent on any one company to help my portfolio grow in the event of a dividend cut. Algonquin. As you can see from the breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. We had 0 dividend increases this month. Boo! And 1 dividend decrease. Uh-oh. That's the first dividend decrease we've had since RioCan did so in 2021. And before that, I can't remember one. So sad, but we'll suck it up. As I mentioned, Algonquin Power and Utilities Corp cut their dividend 40% from 18.08 cents to 10.85 cents US. Their dividend growth streak before the cut was 12 years. We got you, Algonquin. Prove us shareholders right. That decreased our yearly dividend income by $172. A few other awesome stocks we used to own also raised their dividends, like Canadian National Railway, a 7.8% dividend increase, bringing the streak to 27 years, and Canadian Utilities Ltd, a 1% dividend increase, bringing the streak to 51 years. That's just awesome. Our forward dividend income is sitting at $6,853 with a yield on cost of 7.28%. We have a lot of cash to deploy this year. We expect our dividend income to snowball faster as we do. I see my dividends as my little minions that work hard for me while I sleep. With our minions working harder and harder each year, we can forecast where we'll be in about 10 years. We hope to outpace this forecast as the Tfsa contribution room grows in the future. Thanks for watching, guys. Stick with us and subscribe to join us on our journey. Until next time, I'm Mr. Financial.